Hello everyone and welcome back to another video. Please do consider subscribing if you have not already. I really do appreciate it, and let's get right into this one. This is an older chip maker. I'm literally working off of a laptop that has an Intel Pentium inside processing chip, and we all know Intel from being just a legacy chip maker that just got a little bit too comfortable, I feel like, as soon as Nvidia and AMD came along to give it some competition. Um, as of right now, Intel is listed at $48, and they have a $53 price target, which is about 12% upside. And it's basically a hold because it has 28 ratings and 13 are hold, 7 sell, 8 buy. And the stock analysis on this one is a 4, so it's not very good. It's not really heading in a good direction. Not a whole lot of activity that goes on outside of legacy 401ks that are buying this thing. No one's excited or buying Intel just because they want to, and we can tell that by looking at their income statement. So yes, we have seen that their revenue has grown still year over year, and hopefully we'll see a better 2022 for them. We always like to see better outcomes for all companies, but even still, this is just a legacy chip maker where it's losing market share to things like Nvidia and AMD. So we actually see that their net income has come way down from what it was a high in 2018, so 4 years ago, of about 21 billion. Now it's about 19.8. So it's lost, almost 2 billion in net income, and we really just you want to see better from something like an Intel. They should be like one of the top. By market cap, by valuation kind of companies in the world. And yeah, sure, they're up there, but they should be a lot higher because of how much they're needed for computers and for chips and things like that. So they should really be a lot higher. And it's just kind of sad that they've kind of lost their way, and that things like Nvidia and AMD have really come to the forefront and look a lot like they're innovating. And if we see their balance sheet, we can actually see that, okay, total cash has come down compared to 2020. Total current assets is about 57 billion. Total current liabilities is about 27 billion. That's good. That's about double, so that's what we like to see. We can also see that their long-term debt has grown. We don't really like to see that. I wish that I wish that would come down a little bit. No real need for that, especially when you have such high total current assets. You should be able to pay that down somewhat. Total liabilities is 73 billion, and total assets is 168 billion. But again, a lot of that comes from goodwill, things like intangible property. They actually do build a lot of plants and stuff, so they actually own a lot of real estate, I'm sure, and or like just capex, like trying to fix up what they have for facilities and factories. And then if we look at the cash flow statement, we can see obviously it starts with the 19 billion, and we can see that it looks like acquisitions. They have not really made a huge acquisition since I think this was 2017, where they had spent about 14.5 billion on something, as well as 15 billion. You guys can comment what was that. I'm not really sure. I didn't really look into it, so you can let me know. It also looks like, as far as their financing activities, it looks like they have issued some debt, but they have not been paying back as much as they issue. So the CFO should be seeing that, and they should really be doing something about it. That's not what we like to see. We like to see it keeping up with and or more as far as the repayments compared to the issuances. So they keep issuing debt, which is okay, low interest rates and whatnot, but definitely retire some debt at the same time, if not as much as you are paying down. You should be, issuing, you should be paying down the same amount. So that's what we'd like to see. And they also have been a consistent dividend payer. It looks like they have grown their dividends over the last 6 years. So that's a good start as far as it being discounted compared to where its stock price is right now, is that it does pay a discount. And Intel's price has come down a lot to where they, might be considered kind of cheap right now. So that's, again, it's not a bad thing to see that. And then a total portfolio of Intel, if you had invested, its IPO was 1985. So let me try to go back as far as that. Intel's been around for a while, and if we see that $10,000 would actually have, since 1985 at least, would be 1.3 million, which is about 14%. You probably honestly had gotten that from the S&P 500 as well. If I actually just throw in the S&P 500 as a benchmark, we can see what exactly the two would have come out to be. And okay, actually, you made out pretty well if you had invested in Intel first, because they do pay a lot more in dividends, I'm assuming, than what the S&P does. So since 1985, you would have had about 11%, and then compared to that, 14%. So we like to see that. That is a good thing. And their total annual returns, if we look at Intel, we can see that they had some good growth years, but then they also have kind of been lagging in the late. So yes, looks like 2012 they didn't really have that great of a year, down 12%, but then they just kind of grew from there, 30%, 44, down 2%, that's okay, up 8%, up 30, up 4, up 30, down 14%, that's not very good. I think that's where the start of their troubles kind of came from, as far as like with Nvidia and AMD kind of catching up to them. And then 2021 they had an okay year. It didn't really beat inflation. Compared to something like the S&P 500, where it was up 28%, they were only up 6%. So not really what you want to see. A real return of about 21% for this, and a negative real return for Intel. So as of this year, it's actually down 6.6%. So again, anything that you had gained from 2021, you actually have already seen wiped out in the first, basically 2 months of 2022. So anyway, with that, I hope you guys do like this video, and I will see you guys soon.